You're now tuned in to the Desire to Trade podcast, a show where we bring you the best figures of the trading world and teach you how you can become a successful trader. This is your host, Etienne Crete.
Hey, what's up, trader? It's Nkaki, founder of Desire to Trade, and welcome to episode 60 of the Desire to Trade podcast. This episode is an interview I had with Adam Grimes, and I first found out about Adam online through his blog. But the thing I really loved about his blog is the simplicity he brings to trading. Now, we often mention it that simplicity is really important when we talk about trading. You want to be simple, and you want to have something that's solid also. And Adam is really good with that. I remember one article I read about pullbacks, and you really explain how to trade pullbacks, but in a simple way. Now, this is great, and this is what I'm looking for. So I contacted Adam, and then he responded not long after. And you'll see in this interview that there's a lot of good information, a lot of good content. One thing, especially, is the idea of not focusing too much on psychology. Right? We often have this tendency to think that psychology is the only thing in trading, and some people benefit from that by selling things about psychology only and selling formulas for psychology. But Adam really put it down in the fact that psychology is not the only thing, and you need many components to trade successfully. So I'll leave you with this interview with Adam Grimes. I'll come back at the end with the takeaways. Adam Grimes, welcome on the Desire to Trade podcast. How are you doing today?
Doing very well. How are you today?
Very good. Thank you. Thank you. So I want to start by asking you, what is one quote that inspires you or something you like?
Well, it's funny because I just recently did a podcast on trading quotes and sayings, and I took a lot of the famous quotes and talked about what's wrong with them. And I think the danger of having a one sentence saying is that trading is a lot more complicated than that. And something that applies, for instance, stick with your winners. That's true for a certain kind of trading. It's also not true for a certain kind of trading. So it's very hard to find something that, I know you gave me a very easy beginning question here, but I actually think it's kind of difficult. To me, the questions that have universal, or the quotes that have universal application are the ones that deal with discipline and with the importance of really sticking with your method and not making emotional mistakes. But I'm very suspicious of a lot of the trading soundbite wisdom things that are out there because I just don't think they really hold true.
That's a good start. I love it. So the question people often have is, how exactly did you start to trade? How did you get involved in trading in the first place?
Well, so my path is probably a little bit different than most. My first career and my formal education, I was a musician. I was a classical musician, a composer, and keyboard player, piano, but also harpsichord, historical keyboard instruments. And so I was working as a musician and basically just started trading with no knowledge and no understanding even of how hard the game was. I answered some silly, I knew it was probably half a scam, but some silly mail order thing that came that, a course for commodity trading that would show you how to start with one cattle futures contract and eventually corner the whole market, that type of thing. And so my first trading experiences, of course, I lost money very efficiently, very quickly, but something about the process of trading was really fascinating. And I knew there was something that was worth digging into a little bit more. So then I had to get an education. I certainly had, as a kid, I was very into science. So I had a very analytical mindset and, I understood how to think analytically and scientifically, but my formal education didn't really have those quantitative tools. So I had to go through the process of learning all of these things that I needed to know, both in order to trade successfully, but also in order to be able to do market analysis and to understand my trading and basically to be sure. What drove a lot of this was kind of the question of where is this money coming from? How stable is it likely to be? How can I be pretty sure that this is something that I can do for a long time? So that was kind of my strange path into trading.
Mm-hmm. And how long did that take exactly from the beginning where you started to get that email and then from the point where you were profitable?
Well, there were really some ups and downs, and there were some pretty big ups and pretty big downs and flat periods. And I've traded pretty much every market out there. And I would say every time I went to a new market or a new style of trading, there was a pretty big learning curve. But within a few years, I had found a specific kind of trading and was fortunate to just be in the right market environment too, I think, where I was able to have some success. But certainly my first couple years were really just struggles and a lot of mistakes and a lot of very small accounts, but very small accounts destroyed pretty consistently.
And what do you think was the reason for you not succeeding from day one, let's say?
Well, I didn't know what I was doing. That always kind of stacks the deck against you. It also, I had this idea that there were people who knew more than I did, like a broker. At that point, you'd call somebody on the phone. And I had a broker. I remember one point the lights kind of went on for me when a broker called, and I didn't have much money left in the account, but I had enough where I could buy some options. So the broker called and said, we're pretty sure silver is going to go up. We've been talking to people on the floor, and you have this much money in your account. You could buy these call options. And, we really, really have high confidence in this trade. We really think this move's going to happen. And I said, well, I really think silver is going to go down. And he said, okay, that's great too. We can buy some puts. And, I thought at that point, I'm talking to somebody here who, even though, this is somebody who's supposed to be in the business, and, now I know the things are a little bit different. But at that point, I thought this is somebody who was supposed to know more than I did. I realized he didn't. He probably didn't know as much as I did about the markets at that point. So, I just didn't understand the importance of so many things, and trading futures with a small account, I was horrifically over leveraged. And there are tons of stories of people being over leveraged and making a lot of money and getting lucky, but your probability of that happening is pretty small.
Mm-hmm. So can we say that the biggest thing was for you to find your own way, your own method to trade?
Well, I think that was part of it, but it was really understanding, even more than that, I think it was understanding all of the pieces that needed to fall into place, having a method, being able to apply the method emotionally, psychological control, the importance of having the correct size positions for your accounts, not being over leveraged. So it was really the understanding of all of those things. And like I said, I think some of my early success was probably having some of these very basic things, which I was missing pieces of the puzzle, and there was a lot that I didn't understand, but just kind of the luck of the draw, being in the right place at the right time in the right market condition.
Mm-hmm. And how were you able to put all the pieces together? Was it through books, through reading, or different things?
I would say different things. I did a lot of reading, a lot of study, and I think a lot of that was, I realize now that a lot of the things that I was studying in terms of traditional technical analysis, I don't think there is actually the edge there that people think. But, anything, I'm sure there's stuff out there I haven't seen, but, I've looked at a lot of the really exotic and kind of crazy technical stuff, and I've spent so many countless hours with strange things like Gann angles and Elliott wave. I really tried to figure out what was in a lot of these methodologies, and also, simple standard things, indicators. So it was really just a matter of doing a lot of study. I had some mentors who helped me and, helped me avoid some of the most serious mistakes, and kind of learning from my own mistakes and learning from the market too.
Mm-hmm, mm-hmm. That's pretty cool. So I kind of want to take this part by part, because you talk a lot on your blog about psychology, you told me just before meditation, hypnosis.
Mm-hmm,
so
yes.
What do you think is the impact of this on trading?
Well, I think the psychological aspect is difficult to talk about. And it's one of the things that people either overemphasize or underemphasize. And, you might be saying, well, how could you overemphasize it? I think, for instance, there are a lot of people selling trading psychology to the public that is, and what they're doing is just short of a scam. For instance, imagine that I wanted to start a business and I don't know how to trade, but I want to make money from traders. Could I not set up a business like this? I will tell the trader, all you have to do is have a method. And it's very easy to have a method. And I could show them charts of stocks going up or, current, whatever market you want to look at. Let's just say stocks going up, stocks going down. And I could say, you need a system to trade this. And then I could show them another chart of stocks going sideways. And I could say, you need another system to trade this. And I could show them how easy it is if you know that market environment to create a system. So I've just completely trivialized the whole problem of system development and of actually having an edge. And then once the trader has these systems, not realizing, of course, that while both of these systems work in the correct market condition, the problem is knowing when to switch regimes, when to turn one system on and the other system off. And that's a nearly insurmountable problem. Then what I would do is sell the trader a lot of psychological coaching, a lot of psychological courses. And there's this tantalizing idea that, well, if you can't make it work, it's your fault because your psychology is not right. And, I'm not pointing fingers at anybody specifically, but that's something that in the 20 years I've been doing this, I've seen different variations of that. And I think there are a lot of people who say, all you have to do is find something that works for you, and then you have to have your psychology right. Yeah. It's dangerous because it's true. There are Jack Schwager, I heard an interview that he did recently where he said this better than I've ever heard anybody say it. There are many, many, many ways to make money in the market. There are perhaps almost countless ways to make money in the market. The paradox is that each of those ways is very, very difficult to find. So, and that's true. And if you think about it, your first reaction is, well, how can that be true? But then I think when most people who have some trading experience start thinking about it, it does ring true, and it is true. And finding a method is extremely difficult. And it's true that if you have a method and you don't have the right psychological framework to apply it, you're not going to be successful. You could call the best trader in the world every morning, and he could tell you exactly what to do that day, and you could still be completely unable to follow through and not make money. This is completely, of course, leaving aside things like position sizing and appropriateness. So you do have to have the psychology, and you do have to have a methodology that works for you. But the danger is that for people who think that it's all psychology, somebody recently told me trading is it's 100% psychological. I have a friend who is, I won't drop the name, but it's absolutely a name, one of the top 4 or 5 people in trading psychology. And he and I were having a conversation. He said that, the more he learns, the more he thinks about it, the more he thinks that trading is not really about psychology, that it's really about doing the right thing. And I thought for a long time that a lot of problems we think are psychological actually come from the trader not having an edge. If you use a simple moving average cross system, and which over a large sample size will not have an edge, and no matter how good your psychology is, you're not going to make money with that because there's no objective edge in the market. And the solution, one part of the solution, is to actually have a method that has an edge and makes money. And I think people don't pay enough attention to that part.
Mm-hmm. So, of course, you want to keep things simple, but at the same time, sometimes it's true because I see so many people putting all the emphasis on trading psychology, and they're going to tell you it's only about that. But yeah, that's totally right.
Right. And those are rarely people making a lot of money trading who say it's 100% psychological.
And so how would you go about making sure that you have a good system then?
Well, I think you need to understand statistics and do some quantitative work. It needs to be done deeply, but it doesn't have to be, it's not complicated math, in other words, I guess is what I'm trying to say. If you understand the idea of different types of averages and then have some sense of the kind of variability, and then you're able to take your method and look at it on, kind of the first step is to be able to have some kind of back test, whether it's a manual back test or an automated back test, and to be able to say, oh, this method actually does have an edge. It's something better than flipping a coin. And the vast majority of things people are using, that people are sold, people talk about, even people in chat rooms claim to be making money with. I'll give you a little aside about that. I was working for somebody who had published a pattern that a lot of people were talking about. This was many, many years ago. People were talking about, and you could go to chat rooms, people talk about how much money they were making with this pattern. And we basically discovered that the quantitative work for this pattern had not been done correctly. In fact, it was never the person who said they did the work, didn't actually do quantitative work. He just kind of looked at charts. And when we actually crunched the numbers, the statistical edge was there. The pattern had an edge, but it was backwards from what everybody thought. So you had some people who were gurus in chat rooms who claimed to be just making so much money with this pattern. And I can't imagine how that's possible. And it's very interesting because I just recently I just decided, I poke around, see if people are still talking about it, and they aren't. But this was, if you had been a learner at that time, you would have seen a handful of, 3, maybe 5 people who were very visible, semi-famous celebrities in different forums who were talking about this pattern, and you would have tried to apply the pattern, and your results would have been completely different. And you probably would have been told, well, you just got to get your psychology right. You just have to find something that works for you, and this doesn't work for you. Well, it didn't work for anybody. So I think you have to have some understanding of where the odds are. There are different ways to do that. Not everybody has to have a PhD in quantitative, econometrics and stuff like that. But you do need to be able to at least have an intelligent gambler's understanding of the odds, and just to be able to know with some degree of confidence that your system actually has an edge.
But I guess it's not so hard to figure out whether your psychology or your method is missing, right? Because if you test it and it works, then it should be psychology, right?
Well, the problem is then we get in some gray areas because a lot of methods might be a blend of discretionary elements, and that's very hard to test. And it's very hard in that situation to construct an effective back test. And it's also possible, I can't tell you over the years how many things that I've seen that perform well in back test, especially if you don't fully understand what you're doing in the back test or how easy it is just by the time you have an idea and you test it and it doesn't look great, but then you make 2 changes and one change looks better. So you go with that one. And then you make a few more, you make 2 changes and one looks better. By the time you do that process just 2 or 3 times, even with very innocuous changes, what you have risk doing is fitting the system to the data very well. So you have things that look very good in back tests and don't actually forward test very well, don't actually work in the market. So there probably needs to be some period of true out of sample testing, which is difficult. It's very difficult to do that appropriately. But probably better is some kind of walk forward testing and live market data, depending on the frequency of your system, a few weeks to a few months perhaps. And then, you can start to see I suggest that traders evaluate themselves. The only thing when you're acting as a trader that matters is whether you're following your system. And that's how I think we really judge psychology. I wrote a blog post recently, something about the 2 hats you wear. To imagine that you wear a trader. So in one job description, you're a trader. When you're the trader, your job is simply to execute the system, to follow the system exactly. When you are the trader, we're going to evaluate your results not based on whether you made or lost money. You're not responsible for whether the system works or not. You're responsible for only adhering perfectly to the system. But then you also have to step into this other role, which I think needs to be very separate. And in this other role, you evaluate the system. Does the system work? Do we need to make changes to the system? And, then there's probably another role where you're kind of acting as your own boss and you're saying, how good of a job is the trader doing? How good of a job is a system developer doing? And at some point, if you simply can't execute your system, you simply can't exercise good discipline, at some point the boss needs to fire you and you need to find something else to do because you can't be a trader if you can't do that.
I love that analogy. It's pretty cool. And then how do you make sure that your system is good when you are a discretionary trader like yourself?
Well, one of the nice things about this business is that the bottom line really is the bottom line. And you need to understand that even with a good system, you're going to have strings of really good and really bad performance. But you need to look and to monitor that performance and to basically to make sure it's stable. And if something changes, if you're a discretionary trader, one of the problems of being a discretionary trader is not only can the market change, but you can change. And, classically, people have some life event, whether it's an illness or an illness in the family or a divorce or, some type of other financial problem that causes stress that makes it very difficult for them to perform as a discretionary trader. So you kind of have to monitor all of these things, but monitoring your performance and doing appropriate analyses on your performance is pretty much the best way I've found.
And how big is the discretion in your trading? Is it a big part of it or just a small part of it?
I'd say it's a pretty big part of it. My approach is I'm a discretionary trader, but my discretion is disciplined and structured with a heavy quantitative element. So I would say that I'm a true blended discretionary quantitative trader.
So I'm not personally familiar with quantitative trading. And I know some people listening to the podcast are not at all. So can you tell us a little bit what that looks like and what kind of trade you would take with that?
Well, it's not as complicated as you might think, first of all. What we're doing is you just basically want to be sure, and sure needs to be in quotes, but you need to be sure within the bounds of statistics that the patterns you're using actually have an edge. If you are looking at, some magical candlestick pattern, and then we go back and look at hundreds or thousands of events where that candlestick pattern occurred in the past, and we can say, okay, well, when this happened in the past, what happened to the market afterwards? And if we find that that candlestick pattern gives you no advantage, that in the past it was just like flipping a coin, that it was completely random, then you have to really ask yourself the hard question, well, why is it going to be any different when I actually execute this myself? Because if you understand this, if you have a pattern that shows no edge in the past, but you think you can make money with it, then what you're saying is that I think somehow I'm going to be able to pull out these winning trades. When I'm going to know which ones to skip, which ones to take. And it's possible that's true, by the way. It's unlikely, but we should admit that it's possible that somebody might have that skill. If so, that's testable. It's testable on a walk forward basis. But from my way of thinking, if I don't have a pattern that actually has an edge, then I have no sense using it. And it needs to be completely eliminated from my worldview. And things get eliminated from my worldview in one of two ways. One can be that they're tested and we find no edge. For instance, moving average crosses would be one of those tools. Moving averages in most capacity would be another one of those tools. Most indicators would be another thing that just doesn't have an edge as people think they do. Fibonacci ratios. I never, ever, ever think about, look at Fibonacci ratio because I've done so much work and I've been completely unable, and I used to be a believer in this stuff, by the way. So, this is the result of experience and analysis. I've been completely unable to find that any Fibonacci ratio looks any different than any random level in the market. And there's no quantifiable edge. So if it's not there, why am I going to talk about it? If I'm making decisions on things that don't have an objective edge in the market, based on things that don't have an edge in the market, then I literally may as well sit here at my desk and flip a coin, look at a magic 8-ball, open a deck of tarot cards. I'm just using something else that's random that doesn't have an edge. But this is what people do when they use these tools. The other way that things can get eliminated is if they're untestable. And, many chart patterns like head and shoulders patterns, we can structure those in different ways. And I know there's some papers out there that test head and shoulders patterns, but what you're really doing is testing a specific type of pattern, a specific set of those, a specific specification, I guess would be the way to say it, a specific specification of the pattern and seeing if that has an edge. And there certainly are things that are too subjective to test. And I'm very suspicious of using those as well.
And where does the discretion enter into play in your trading? Is it when you trade or?
I guess one way to think about it might be if you had these quantitative systems running that would give you trading signals, but rather than actually taking the trades like a systematic trader would, you use those as advisors. And you literally imagine that you've hired advisors and they're giving you your opinion. And then you, the discretionary trader, synthesize those and make the decision. That's a little bit oversimplified, but not that much. That's the concept.
So what are the factors you would consider when you decide to enter or not the trade?
Well, I tend to be fairly quick to get into trades, but then also fairly quick to get out and tend to reduce open risk in trades pretty quickly. So I'll get into a trade at what I think is probably an inflection. And if it doesn't develop pretty quickly, then I'm out of the trade. So it's just basically it's pattern recognition, seeing the pattern that shows me that there might be an edge and then seeing if the edge plays out in the market.
So I guess one of the big key here is that you're able to scrap your trade, right? If they don't work.
Yes. Yeah. I think you have to be, at least for this kind of trading, you have to be willing to get in or out with a small loss.
Mm-hmm. That's pretty interesting. So what is your main trading style today? Is it mostly longer term or shorter term?
Most people would call it swing trading, but I don't think swing trading is really a time frame. I think swing trading is a style. I think you could be a day trader swing trading or a swing trading long-term investor. So it's a swing trading approach, but looking for trades that last a few days to a few weeks, kind of in that time frame.
And are you in the market daily? So are you looking at the chart daily or?
Yeah, I'm actually looking at markets, even though I may not make many trading decisions, but I'm looking at markets many times throughout the day.
And what market are you trading? Is it futures?
It's stocks, futures, currencies.
Okay, currencies as well. Okay, interesting. So this is something interesting because some people try to switch between different markets, such as Forex, and then they go to stocks. Can you apply the same methodology most of the time, or do you change a little bit depending on the market?
Well, so I'll tell you up front before I say this, it's a little bit of a joke. One of the things that so many technical people tell you is you can apply any technical methodology to any market with the same results. And I think that's true because most of those technical methodologies they're talking about have no edge, and they'll have equally no edge in whatever. It just doesn't work. So it doesn't matter. Sure, it doesn't matter what you do with it. You can do whatever you want with it. More seriously, though, different markets have different characteristics. And so some adaptations are necessary. For instance, on many time frames, stocks will tend to reverse more often than, say, currencies. So the instincts that you develop trading currencies may not serve you very well trading stocks. There certainly are broad methodologies that can be applied to both, or to different asset classes, but there are objective differences in the power of mean reversion and momentum in different asset classes that I think anybody who tells you, oh, you can just take my really great system and apply it to every market, I don't think that's true.
Yeah, no. Yeah, same here. I don't believe that at all. No. And so one of the articles that I remember seeing on your blog was about how to trade pullbacks.
Yes.
And what I noticed from that article is that you really take things simply, like compared to people who are going to put moving average and tons of stuff on their charts. Your basic methodology was really simple. Is it the same thing you're using now? And can you tell us a little bit how that works?
Yeah, I think trading a pullback is one of those concepts that work. Every now and then I will talk to a group of traders about trading pullbacks, and there's always some smart guy in the meeting who says, oh, everybody knows about trading pullbacks. This is a waste of time. Well, it's also one of the things that really works and works very well. So it's not a waste of time. The idea of trading some kind of pullback, some type of consolidation, some type of pause in a trending market is a robust concept. It may be if you were an intraday trader, it's maybe a little bit more difficult because many assets don't trend that well intraday, but it still can be done. For the long-term investor, this is basically what you're doing. For a swing trader, it's certainly a valid approach. And, you have to figure out exactly how to structure these patterns. But I do think in general, keeping things simple is the way to go. And, the people who add moving averages, the question that I would ask them is, okay, so you think having a 18 period, or a lot of times it has to be some Fibonacci number because they think that's a magical number. You have this 18 period moving average on your chart, and you're going to buy when price comes down to the moving average. But, go back to what I said earlier. What happens if we go back through years of market data and we look on your time frame every time price came from above and touched the moving average? What if we did that and then found that what happened after that was completely unpredictable? That, in other words, the moving average adds no information. Technically, what we might see is if we separate, let's just say we're looking at every bar after for, 100 bars. And if we take every single bar with, it doesn't matter what the condition is, and we look what happens every bar if you just randomly bought every bar and looked 100 bars out. And then we take the subset of that where price touched the moving average. That subset had better look different. We need to, and what that would tell us is that the moving average provides some information. That if you're going to buy because price comes down to the moving average, well, shouldn't historically price have gone up after it came down to the moving average? And the people who are so sure of these things, or the slope of moving averages, or moving average crossing, or moving average ribbons, I've seen all of this stuff for years and years and years. These people have never tested this. And the answer is always something like, well, can't you just see it works? Look at these charts. Let me show you these examples. And no, anybody who understands human cognitive quirks and how we see patterns where there are no patterns nobody who understands that would ever say, oh, look, you can just see that it works, because you actually can't. And this is why we have to do some type of actual number crunching to really understand the odds.
Mm-hmm. But for those people, this is something I talk about a little bit also. I think people are going to do what they feel really comfortable doing. So if they have a complicated system, they feel probably a lot more comfortable trading it instead of testing it, right?
Most people are going to lose money. So most people are going to do what feels comfortable, and they're going to do it with no real success for a number of years until they eventually stop trading and have had no success. You're absolutely right. Most people are going to do that. I think in the market, there's one, you asked about a market saying early on, there's a market saying that says you can lose your opinion or you can lose your money. And I think the challenge really, with a lot of people, complexity is not the answer. A lot of these quantitative systems that people think are so complex really only run with a few parameters. A lot of them are much simpler than people would ever imagine. So the answer is not adding 6 indicators and 8 different moving average bands and all these color rules to your charts. This is just futility because you don't understand how the market works and you don't have something that has an edge, and you're hiding that lack of edge in complexity. And when you have complexity, you have more moving parts. You also have more, goes back to this kind of seductive, tantalizing thing where you think, oh, if I could just get this right and maybe I better work on my psychology. And, you see the whole problem is you don't have an edge. You have no business risking money until you have an edge.
Mm-hmm. So if I were to look on one of your charts, what would I find exactly?
20-period exponential moving average with Keltner channels and a modified MACD underneath. And that's what I have on all of my charts.
Okay. And that basically guides you through any of your strategies, right?
Yes. Yeah. And I really don't use the MACD. There are some other things that I will use when I'm writing research for my clients or doing different types of analysis. I might do some volatility adjusted measures. I have some algorithmic tools that will draw swings on charts. So I'm not just doing it subjectively, but I don't use those very much. And I would say, I refer to the MACD maybe 1 out of every 20 times. So it's certainly not certainly not a primary thing. Most of the things that I'm looking at are patterns in price and patterns. And, I said a 20-period exponential moving average, but it really doesn't matter what moving average you use. It's just the concept of having an average price or price being around an average price. But, 15, 18, 20, 25 simple exponential triangular, whatever moving average you want to use, truly does not matter. We just need some measure. Is price around an average price, or is it extended from that average price?
And what impact do you give to candlestick or price action, as we could say?
Not as much as most people do, because most of these things, if you test them, they just don't have an edge. Most of these candlestick patterns have really great names. And of course, I can go back through and show you, subjectively where they work so well on example charts. But if you actually crunch the numbers, there are no candlestick patterns that I've been able to find that have an objective edge. So it's not something I ever look at or ever really think about.
That's interesting. Really interesting. So do you have any other advice that we'd like to give traders today?
Well, I think not my advice, but Jack Schwager's advice that I mentioned earlier, that, you need to remember there are so many different ways to trade. There are almost countless ways to make money in the market, but each of those ways is very, very hard to find. And I think remembering that this is a difficult thing to do, and it's very easy to get discouraged. And I think just having some understanding that the learning curve is likely to be many years, and that the first stages of success are you stop losing money. I've had a number of traders come to me and say something like, I'm quitting. I'm giving this up because I've been doing this for 3 years and I'm just at the point where I'm breaking even. I'm not losing money, but I'm not making money, and I give up. And, I say to those traders, that's a huge mistake, because what you have just described is success. That's the first stage of success. You go through this situation where you're losing money, and then eventually you stop losing money, or you mostly stop losing money. And that's the first stage of success. But that may take many years to get there. It may take 2 to 3 years to get there. And then the next step is you're making a little bit of money. Maybe you're covering your commissions. You're paying for your data services. Your trading is still kind of net break even. And maybe now we're 3 to 5 years into the journey, and you need to know that before you start. That's completely normal. That's absolutely to be expected. And from there, then you can start making money and start figuring out how to make money. But too many people are in this for a quick buck, and it's definitely a skill. And developing that skill just takes time. It takes time to grow into it, and it's not even really none of this is as complicated as people think. Even the quantitative stuff that I was talking about here earlier, that's not difficult. Anybody with high school math can, in the course of a few months, learn to use Microsoft Excel. There's so many great resources online. You can learn all the basic statistics that you need, and you can have the tools to do basic quantitative analysis and find out if you have an edge and find out what that edge looks like. And then, like anything else, there's an art aspect. It takes some time to refine it, but nobody should be put off by thinking they're not smart enough to do this, because it's not really about being smart. It definitely is a skill, and it just takes a lot of time to develop the skill. I think that's really what people need to know when they get started.
I love it. And so you have a podcast out there. You're putting a lot of stuff out there, a podcast, a blog. So how can people find you exactly?
So I do have a few things out there. I have a blog. You can find my blog at adamhgrimes.com. And I blog there a couple times a week. I also have a mailing list that, a couple times a month I will send to the mailing list. I don't spam. I don't sell anybody's email address or anything like that. And I do have a podcast. You can find my podcast on iTunes. You can also find it from my blog. A few other things. I also have a free trading course, and you can find that from my blog. Just go to adamhgrimes.com, and there's a link to the course. The direct address is adamhgrimes.com/TCC TAAS, the Art and Science. And this is it's a course that I think in some sense it has everything you need to know for a certain kind of trading. There's 30 hours of video. It truly is free. And it's not just me. There's some other pretty big names have contributed to the course. There's no premium area. There's no upsell. It's completely free. It's a gift to the trading community. In terms of paid things, I do have a book, The Art and Science of Technical Analysis, which has been able to help a number of people along their journeys. And then I also am the CIO of Waverly Advisors, and we publish daily research in all liquid asset classes for short-term traders all the way up to long-term investors. So you also can find me there and take a look at that if people think that might help their trading journey.
Wow. So we'll make sure to put all the links in the show note. If you guys want to check out the show note, desiretotrade.com, we'll put all the links that we talked about right now.
Thank you.
You can find you. And so what are your goals for the future, Adam?
Well, I think I'm very interested in continuing to grow my firm, Waverly Advisors. I wanted to build something that really kind of went beyond just me as an individual trader. And we've been very fortunate by serving both retail clients and institutional investors. I think we really, at the same time we built a business, we also have been able to really help people manage risk and understand markets a little bit better. So I'm very focused on that. I have a few new projects in terms of some trading ideas and some mentoring and things that I'm getting out there and doing. And then I'm also, I'm very focused also on life beyond trading. And, I look for ways to keep my creativity fresh. I write. I recently got into photography. I cook a lot. I did a stint, served an apprenticeship with one of the top French chefs in America. So I do a lot of cooking for fun. I do a lot of things outside of markets too. So I think maintaining that elusive work-life balance is very important.
And what's your main motivation to do all this? Because you have a lot going on.
Well, I think, I guess the best answer for that is that it's just what I want to do. It's the everything I do because it interests me, it engages me. And, if that changes, if I don't have the interest, then I'll find something else to do. But it really is just a matter of, I guess, kind of keeping those creative juices flowing and, always looking to kind of make something new and grow.
Awesome. And Adam, there's one last question we always ask the guests on the podcast. And it is, if you could give only one piece of advice for traders, one sentence, what would that one sentence of advice be?
Don't give up.
I love it. I think that's powerful. Yeah. So Adam Grimes, thanks a lot for being on the podcast. It's been a pleasure to have you here.
Thank you. I enjoyed it very much.
I think it was nice to speak with Adam, especially about discretionary trading, because it's something that a lot of people go into without really knowing what they should expect or what they should do to prepare. But Adam really talked a lot about that. So I'm glad about it. And the other thing I like that Adam talked about is the idea that you can lose your opinion or you can lose your money, right? That's super powerful. As a trader, in the end, you'll always be your own boss. And you have to make sure that you put the right things in place so you get better over time and so you get some profit over time. But you have to develop this. And lastly, I would say don't forget that there's countless ways to make money in the market. You just have to find one that is right for you, one that you're going to be able to test, and one that you're going to be able to stick to. Now, if you like the episode, I would love if you can leave a review to the podcast. Take 2 seconds and leave a review on your favorite platform, whether that's going to be iTunes, Stitcher, or whatever else. And then send me a screenshot of your review at podcast@desiretotrade.com, and I'll send you a bonus back. This is not only for me, but it's to help the podcast grow and to make sure that together we have a bigger impact on traders. And the more traders we can help, the better it's going to be, because trading is not easy. And it's an area of my life that I wish I would have received help in at the beginning. So if people can get the help right from the start, they're going to be able to get to their goals much faster. And I'm all about that, having a positive impact on people. So send me that screenshot. And I'll leave you for right now, but I'll come back next week with a great podcast. And I'll look forward to see you in the next episode of the Desire to Trade podcast. Ciao.
Thanks for listening to the Desire to Trade podcast. To get all the information on this show, free articles, and unique resources, make sure to check out www.desiretotrade.com and subscribe. Please leave us a review and let us know what you thought about the show. It's time to become the best trader you can be. See you next time.